Volume is one of the most important factors in trading. Understanding how it works and how it can be useful in some trading strategies is crucial. That's why I decided to code a very simple strategy based on it. Backtest it using TradingView Strategy Tester to see whether it could be actually profitable and where. So, let's dive into it! If you like this strategy, along with smashing the like button, make sure to reach us on Discord. There you'll find more than 20 free strategies, all ready for backtesting and going live with the simplest alert functions possible. Now, let's get straight into the strategy. Volume is the representation of the buy and sell pressure in that particular time period. This strategy is a reversal strategy. That means that after a signal is generated, we expect the price will change direction. And we pay our attention on these huge volume spikes. Probably someone will ask, okay, but why the price should go down after these huge spikes? There could be different reasons, but one of them is that the majority of buyers did already buy, so basically the buy pressure is way lesser. A lot of these buyers want to exit from their position because they are in profit. Let's say that the trader enters in a long position here. Then the price goes up, it will be in profit. And of course, to want to take profit, and in order to take profit, he must sell. And he starts to sell, and others start to sell. So that could be the first reason because the price starts to go down. Another reason could be all the reversal traders that after seeing a huge price movement, they start to open short positions. These are the two main reasons why we should expect a reversal in price after these huge spikes, both in volume and the price movement. I coded this strategy only for short position because I realized that this strategy works really well with the short position. As you can see here, it could work even for a long position, but I usually use this strategy only for short side. By opening our strategy script, we have a volume threshold, which basically the higher this number and the bigger will be the volume spikes detected, and the percentage bar will measure the percentage of the candle. So here we have 1. In order to have a short signal, this price must be higher than 1%. In fact, as you can see here, it's 2.50%. In addition to the volume spike and the size of the candle, short signal is generated when this candle is green. We can set a moving average filter. That means that considering that we are aiming to catch price reversal, it will work that the strategy will enter in a short position only if the price is above the moving average, because we are aiming to catch a reversal point, so the price must be overextended in an upward direction. Before we check the backtest results, I want to make an important point. I know many believe a strategy can make money on all pairs and time frames, and it sounds fancy and appealing. We have heard it so many times that it can make us think it's true. Unfortunately, it's not that simple. Let me explain it in the simplest way possible. Each pair behaves differently, and each time frame too. This happens for 1,000 of reasons. One of them is the presence of different actors, protocols, bots that trade various markets in different ways, making each pair on different time frame unique. In fact, even with closely related markets, you'll notice different behaviors when you change the chart, even if many are similar. As you can see, now we are on BTC. Let me try to change a random chart. This is a different chart. This is different as well. This is another and it's different. I can guarantee you that each pairs, and you can check by yourself, that each pairs has its own behavior, even if some movement is similar and some pair is slightly correlated with another pair, but it will be different. That's why a strategy isn't profitable on one pair, but it might be on another. It's like saying a nice dress will look good on everyone, regardless of their physical features. That's simply impossible. There is no perfect strategy, but there is a strategy that fits well with a specific market. Also, if a strategy is considered a loser because it's not profitable on all pairs, for consistency, it should be a loser on all pairs. So why is it profitable on some pairs? It doesn't make any sense. But probably this is just my opinion, but as you can see from this example, it does make all the sense. But please, let me know in the comment section or on Discord what you think. This is a concept as simple as it's overlooked, and I want to be clear for those who follow me. Now, after this theoretical preamble, which I hope that didn't bore you, let's jump into backtest results. We are here on BSV USDT 45 minutes time frame on Bybit exchange. I leave the default settings 2.5 volume threshold, percentage bar 1%, moving average filter apply using exponential moving average, 150 moving average length, order size $10,000 with a fixed amount, 2x leverage, 0.06% commission. We are going only short, stop loss type percentage, take profit percentage 2 and 4. Let's see the backtest results. As you can see guys, we have a really spectacular and steady equity line. I really love this kind of equity shape. Net profit 268%, 180 total closed trades, 47.78% win rate, 1.67 profit factor, 17.25 max drawdown, and 0.75% average trade. We have a net profit slash drawdown of 9.3, which is really huge. Daily profit 0.35%, max win row 6, max loss row 6, risk reward 1.83, average win 7.78%, average loss 4.26%, max win trade 7.82%, max loss trade 4.3%. We are backtesting more than 2 years of chart. Let's check other statistics. Buy and hold return minus 24.84%. What I like the most of this strategy is the equity shape and the theory behind the strategy. If we try to disapply the filter, as you can see, we have still a good equity. Net profit slash drawdown is a little bit lower, but isn't changed so much. I did backtest only with fixed percentage exits, but you can set trailing stop percentage or stop loss condition. As you can see from the chart, the stop loss condition will exit at the high of the entry signal candle. In fact, as you can see here, we have a short position, here the high, and the stop loss is exactly at the high of the entry candle. As you can see, by switching our stop loss type, we still have a profitable backtest. We have a much higher risk reward, almost a double, but the percentage profitable is much lesser, so 30.71%. Considering the equity shape, I would prefer a fixed stop loss, but just in case you want to backtest with this kind of stop loss, you can have the possibility to do that. If you like this reversal strategy, you can consider watching this other one, which is a reversal strategy as well.